Hi there. In this video, we'll explain how the 2026 R&D merger affects UK business claims and why understanding the changes matters.
Picture this for a second. You're a UK small business owner, right? You've just poured £100,000 into this groundbreaking, highly complex tech project. You've taken all the commercial risk, and you're really counting on that vital R&D tax relief to fund your next big phase of growth. But then, out of absolutely nowhere, HMRC automatically rejects your claim. And the worst part, it's not because your innovation wasn't brilliant, it's not because the science was flawed, it's literally because of a single, easily overlooked misnotification deadline. It's a catastrophic problem that UK entrepreneurs are completely overlooking right now, and honestly, the financial consequences can be devastating.
Hello, and welcome to today's Explainer. Today, we are diving into one of the absolute most pressing questions we've been getting from businesses up and down the country: how the 2026 R&D merger impacts your small business claims in the UK. The whole landscape of innovation funding is fundamentally transformed, and getting ahead of these changes isn't just important anymore, it's absolutely essential for your survival. But hey, don't panic, because you're not navigating this maze alone. We are Pro Tax Accountant, or PTA for short. We're your trusted UK accounting firm, and we specialize in helping businesses exactly like yours understand and actually master these incredibly intricate tax rules. We're here to rescue your innovation funding from the chaos of all these new regulations and make sure your claims are completely rock solid. Okay, let's dive into this. Here is our Q&A survival guide agenda for today. 1. The 2026 R&D rules. 2. Merge scheme or ERIS. 3. Subcontractor and overseas rules. 4. Crucial new compliance steps. 5. Costly mistakes to avoid. And finally, 6. Summary and next steps. Starting off with Section 1, the 2026 R&D rules, and the end of the old SME and RDC divide. So it's been a bit of a whirlwind, hasn't it? For years, the UK operated with two very distinct systems, the SME scheme and the RDE scheme. Well, as of the new legislation, that historic division is officially gone. Things have changed incredibly rapidly. Back in April 2023, the ERIS pathway was introduced for intensive SMEs. Just a few months later, in August, the Additional Information Form, the AIF, became this mandatory hurdle. Fast forward to April 2024, and the merge scheme officially replaced the legacy systems for accounting periods starting on or after that date. And now, here in 2026, these rules are fully mature. The grace periods are totally over. HMRC is enforcing these regulations with unprecedented strictness. The days of submitting a casual claim are well and truly behind us. We are now in an era that demands absolute precision.
Moving right along to Section 2, Merge Scheme or ERIS, deciding which pathway actually applies to your business.
With the old systems totally stripped away, UK businesses now basically face two distinct pathways to claim their R&D relief. The merge scheme is your new universal default. Whether you're a massive multinational, a highly profitable SME, or just a standard loss-making SME, you're highly likely to fall right here into the merged scheme. It operates as an above-the-line taxable credit, which completely changes how relief sits on your profit and loss statement. But on the flip side, we have ERIS, that's Enhanced R&D Intensive Support. Now, this pathway is heavily gate-kept. It is strictly reserved for loss-making R&D-intensive SMEs, and it continues that older, highly lucrative enhanced deduction model that so many smaller innovators really relied on to survive those early development stages. So, what does this actually mean for your bottom line? Let's put some real pounds and pence to this. Say you spend exactly £100,000 on qualifying R&D. Under the standard merge scheme, you get a 20% gross credit. But because that credit is taxable, your actual net financial benefit works out to be somewhere between £15,000 and £16,200, depending on your corporation tax rate. Now, contrast that with ERIS. If you qualify for ERIS, you get to apply a massive 186% deduction to your qualifying costs. This mechanism can yield a non-taxable cash credit of up to £27,000. Think about that. You're essentially getting up to 27 pence back for every single pound you spend on innovation. That gap in value is absolutely huge, which is why it's so vital to know exactly which scheme you belong to. And because of that massive financial difference we just looked at, the absolute most crucial number for smaller businesses to understand right now is 30%. To unlock that incredibly lucrative ERS pathway, your business has to meet two really strict criteria. First, you must be loss-making, and second, your relevant R&D spend must make up at least 30% of your total business expenditure. This means meticulous bookkeeping isn't just a nice-to-have anymore, it's mandatory. If you can prove you hit that 30% intensity threshold, your innovation funding goes through the roof, giving you a vital lifeline. But
And this is a big but. Falling even a fraction of a percent below this mark means you default right back to the less generous merge scheme, and that could dramatically mess up your cash flow projections for the entire year.
All right, Section 3, Subcontractor and Overseas Rules, Navigating Strict Geographical Boundaries.
Time for a quick insight. Did you know, under the new merged scheme, all companies, no matter their size, can now claim 65% of their qualifying UK subcontracted costs? Sounds great, right? However, HMRC has clamped down hard with a strict anti-double-dipping rule. Only one party in the supply chain can claim the relief for any given project. So how do they decide who gets it? HMRC looks at who is making the strategic decision to carry out the R&D and, crucially, who is bearing the financial risk if the project completely flops. If you're just providing a routine service to someone else's R&D project and you're getting paid whether the tech works or not, you cannot claim. The company taking the ultimate commercial gamble is the one holding the key to the tax relief.
We've also got to talk about the sweeping overseas restrictions. The government really wants to keep innovation firmly rooted in the UK economy. Because of that, the general rule now is that overseas third-party costs, like externally provided workers or foreign subcontractors, are completely excluded from your claim, period. Your R&D staff generally need to be on a UK payroll subject to PAYE. Now, there is a very narrow, fiercely contested exception if specific geographical or environmental conditions exist abroad that physically cannot be replicated in the UK. We're talking things like deep ocean testing or a specific clinical trial that requires a demographic you just can't find in Britain. But let me be super clear about this. Outsourcing your coding to an overseas team simply because the labor is cheaper or the turnaround is faster? No way. Not a valid exception. Those costs are simply lost, meaning you have to carefully map out your supply chain geography before you even start a project.
Section 4, Crucial New Compliance Steps. We're looking at forms, deadlines, and portals.
Okay, listen up because here is a massive professional tip. If you take literally nothing else away from this explainer today, please remember this. Submitting your CT600 tax return before you have submitted your Additional Information Form, the AIF, will result in an automatic, irreversible rejection of your R&D claim by HMRC. The system will just lock you out. Boom, gone. It is a catastrophic administrative error that has already cost businesses tens of thousands of pounds, but it's entirely avoidable if you just follow the correct operational sequence. HMRC's digital systems are incredibly rigid now. They do not allow for retroactive corrections if you get these steps out of order.
Let's move to the exact steps and see how this builds into a very specific, mandatory chronological process. Step 1. If you're a first-time claimant, or you haven't made a claim in the past 3 years, you have got to submit a Claim Notification Form, the CNF, within exactly 6 months of your financial year end. Step 2. You submit the detailed Additional Information Form through HMRC's dedicated digital portal. And finally, Step 3. Only after that AIF is fully submitted and accepted by the portal can you file your CT600 company tax return. And when you do, you must make absolutely sure to tick box 657. That tick digitally confirms to HMRC that your AIF is already sitting in their system. Getting the sequence right? It's completely non-negotiable.
To give you a really practical business example of just how unforgiving these timelines actually are, take note of this urgent deadline, 30 June 2026. Let's say your business has a December 2025 financial year end and you're a first-time claimant. You absolutely must file your claim notification form by this specific date. If you miss this tight 6-month window by even one single day, you completely lose your right to claim for that entire accounting period. There's no "my dog ate my homework," there's no appeal process, the money is just gone. And this is exactly why proactive planning, way before your financial year even ends, is incredibly vital.
Now back to step 2 for a second. The Additional Information Form. So many businesses are significantly underestimating the workload here. This is not just a quick essay or a high-level summary. It requires exact, granular details. You have to provide your UTR and payee references, your specific SIC code, and crucially, a highly structured technical narrative. You've got to clearly explain the baseline of science or technology as it existed before your project even started, then define the specific technical uncertainties you faced, detail exactly how you systematically tried to overcome them, and map all of this directly to a detailed breakdown of your qualifying expenditure. Honestly, this is no longer just a job for your accountant. Your finance directors and your lead engineers have to build this document together to survive HMRC's intense scrutiny.
Section 5, Costly Mistakes to Avoid. Let's talk about how to protect your innovation lifeline.
HMRC compliance checks on inquiries are literally at an all-time high right now. To protect your funding, you need to know exactly where other companies are tripping up. The most common 2026 pitfalls we are seeing include: first, missing that unforgiving 6-month claim notification window we just talked about. Second, trying to claim standard, routine software development. Building a basic app, a standard e-commerce site, or just upgrading existing legacy systems as qualifying R&D. It doesn't count. Third, failing to thoroughly audit commercial contracts, meaning you actually can't prove who holds the right to claim in a messy subcontractor relationship. And finally, improperly trying to bundle overseas externally provided workers into the claim, completely ignoring those strict new geographical boundaries. Making any one of these mistakes can trigger an exhaustive, highly costly HMRC inquiry.
So, when you're in doubt, always come back to this core fundamental definition. What is qualifying R&D? It means your company is actively trying to achieve a measurable advance in science or technology by resolving a scientific or technological uncertainty in a systematic way. It's about pushing the boundaries of what is currently possible in your entire industry, not just what's new to your own company. And remember this absolutely crucial fact: if your project meets this strict technical definition, even if the project ultimately failed, ran out of budget, or was completely abandoned, you can still likely claim for the time and materials you spent trying to solve the problem. Innovation inherently involves risk, and the tax relief is specifically designed to reward the attempt as long as it meets those scientific criteria.
And finally, Section 6, Summary and Next Steps, Securing Your Claim with PTA.
Real quick disclaimer before we wrap things up. R&D tax relief is incredibly complex and constantly evolving. This explainer provides general information and shouldn't be taken as tailored tax or legal advice. Your unique tax position, your corporate group structures, and all the granular details of your specific projects will ultimately determine your actual outcome.
And that sheer complexity is exactly why you really shouldn't be navigating this alone. Please reach out to us at ProTax Accountant. You can call us directly on 079-856-89912, shoot us an email with your questions at info@protaxaccountant.co.uk, or check out our website at www.protaxaccountant.co.uk. We've got the technical and financial expertise to make sure your claim is totally robust, fully compliant with HMRC's strict 2026 standards, and maximizes the funding you rightfully deserve. Our team understands both the accounting side and the complex technical narratives you need to succeed.
So, what should your next steps be right this second? First, review your supply chain contracts immediately so you know exactly where the risk and decision-making for your R&D sits. Second, double-check your financial year-end today to make sure you aren't about to miss a looming claim notification deadline. Third, contact PTA for expert, tailored advice to map out your specific strategy. And lastly, if you found this explainer helpful, please hit subscribe on the PTA YouTube channel so you never miss a vital update. Leave you with this thought. With compliance checks at an all-time high, can you really afford to leave your innovation lifeline to chance in 2026? Protect your business and get in touch with us today. Thanks so much for watching.